Good day to one and all. This is Dr. Sivaraman of iknowindices.com. We are into the new week, 17th to 21st of October. It is the third week of this particular month of October. We are on 17th of October. Today, that is on Monday. Between 5 and 5:30 GMT, I will give you the Asian Session Live Market Analysis and the Forecast webinar. And this webinar I give every Monday, giving the expected market moves for the 3 sessions of the days of the week, besides the range in which the currencies are expected to make swings in this particular week. So the forecast is given in a broader perspective, and also it is fine-tuned using that of the market reading. So I explained to you the methodology by which we can fine-tune the forecast and find out how exactly the players intend to make the moves in the market. Then also I'll explain to you the trading strategy which you can adopt so that you can minimize the risk and maximize the profit. So ultimately the system is developed in order to take least risk and maximize the profit. Because you know very well, any market for that matter, the speculation plays a vital role. Because people envisage that there could be a surge on the upside or a big drop on the downside every time. And especially during that of the weekend, people try to give various types of interpretations, assuming that the forthcoming events are going to dictate the terms for that of the market. So as usual, this week you come across the FOMC is expected to make the announcement regarding the interest rate decision. Besides, ECB is also expected to give the announcement. In line with that of the expectations, many people will say that the market might come down drastically and it could show more of a USD gaining move or more of a USD weakening move, etc. But ultimately, we need to understand which way you have to take the trade. See, there could be a bearish feel in the market. It doesn't mean that all the sell and buy traders will make money. Similarly, there might be a bullish feel in the market. All the buy and sell traders may not be able to make the money, because when you enter and when you exit are vital, and they are going to determine how much of profit you are going to do, or are you going to do, first of all, a profit making trade. So for that, we need to understand when to enter and when to exit. The conventional statistical analysis do not explain the time frame for that of the entry and the exit. They talk in terms of levels. So a specified level is considered as a support, and another specified level is considered as a resistance, so that the market is expected to make the swings between the support and the resistance. And we know very well that the market is known to breach the support and the resistance. In such events, you come across various other type of statistical analysis could be taken into consideration to find out, in the event if the support is breached, what could be the next level of support? What could be the next level of support? So endlessly we can go in for this sort of what could be the next level of support. But that does not give any trading idea to that of the traders, because the traders, when they think that okay, is the first level of support, second level of support, third level of support, then the trader wait for the third level of support, assuming that market may not go below that, but the market might breach that and reverse. In such a situation, he wants to do the bottom fishing, but the market fear induce him to avoid taking any position. Because of the past experience, he feels that many of the occasions when he has taken the lowest level, the buy, still the stop and move happened, and then subsequently he was stopped out. Later on, the market has moved in his specified expected direction. So, why such failures happen in conventional trades? Because in conventional trade, the stop and moves are considered as noise, and they are considered as above that of the resistance or below that of the supports, some noise. But during such noise only, our stops are being filled out. So how can we ignore such noise? So the best assumption could be that whenever such a noise happens, then probably we can enter into the market. There are occasions wherein they breached the, they made the, breached the support of the resistance as a noise and continue the direction. And then you find that the trader is caught unaware. So ultimately, we need to find out why such things happen in the market. For that, the basic understanding should be it is a man-made market. Men trade against men. Those who have got a huge money power trade against the other traders who do not have that much of money power. So obviously they are able to make big moves in the market using specified type of trades, whereas the others are not able to do such type of trades. So what is important here is understand the intentions of such big players and then try to trade, finding out the limitations of such traders. Then you will be in a position to earn money from that other market. So for that, the overall picture is given in the form of a gross forecast. A derived forecast. The derived forecast is obtained by using a sequential statistical analysis. And this analysis is independent of the market moves. And it is taking into consideration the factors which influence the market, either directly or indirectly. And such influencing factors are being taken into consideration to find out how exactly the market is expected to behave, whether it is going to show the bearish US dollar sentiment or bullish US dollar sentiment. Then this particular derived forecast is fine-tuned using the market trading technique. For that, we note down the initial lows and the highs with the help of the live market code page, the low and the high around 3:30 GMT, and find out where exactly the market is heading, either below that of the initial low or above that of the initial high, to find out what sort of moves the players are doing. And also we take into consideration the session timings. The session timings are vital because we need to understand when the players are going to be very active, when they are going to be subdued, and when they are going to be active in specified measures. So that we need to understand. And once we understand, okay, they are going to handle euro now, then it is easy for us to take a position in euro so that we will be able to easily book profit. Instead, we have taken a position in the case of GBP and expecting it to go up. And when it is not going up, then you feel frustrated. Because we need to understand by looking into the live market code page and make a relative study of them, which currency pair they are handling at a given time. So if we look into the live market code page, here it is being displayed, the four majors and the two commodity pairs. Wherever you come across the spread between the high and the low is more than 40 pips, they are very active in handling that currency. The spread between the low and the high is less than 40 pips. Then there is no point in taking position in that currency because they may not be able to make any big move in that particular currency, and you will be simply waiting by holding the position. So first of all, you have to decide from time to time which currency you are going to take, so that based on the spread between the high and the low, so that you'll be able to quickly close the position. So it is not that you come across the specified type of curves are being formed in that charts, and then you find that market is closer to that of the pivot point support and the resistance, and you wanted to take. Probably your decision may be wrong, but the currency may not move. Then in such a situation, you will be simply holding the position. Because the players also, when they are taking the positions in the market, they need to pay the margin to the bank, and so they cannot give trillions and trillions of dollars in order to handle all the currencies. So what they do is they handle only two currencies at a given time. The rest of the currencies, they do the circular trades. So wherein they are making the circular trades, the spread between the high and the low will be less than 40 pips. The currency wherein they are making the active move, the spread will slowly increase to more than 40 pips and then continue to breach the high and go above, or breach the low and go below during the day. So in such a situation, you can take appropriate positions. Now, let me explain to you the expected market moves for this week. Today, 17th of October, this is the third week of October. The monthly trending moves are expected to happen. But still, this being the beginning of the fourth quarter, they are expected to make some big volatile moves and accumulate positions. What they do is they quickly drop the market and accumulate the position, quickly gain the levels and book profit, and again drop the market and accumulate buy position, quickly rise the market, book profit. Then they do 2-3 times like that, a circular trades of about 100-150 pips. In such a situation, what happens? They gain adequate profit. And once they gain adequate profit for the quarter, then they start buying at a higher level and rise the market. So what happens with the profit gained, even though they make a higher level buy, the average will be still much lower than that of the market price. So that at any given time, they can exit out of the market the event there is a knee-jerk reaction happens in the world. Suppose somebody suddenly dies, then you find the market collapse. In such a situation, they will not be incurring huge loss. They'll be able to exit out of the positions, and then still they will be in the money, taking into consideration the average profit they have done it with the help of the circular trades. So you have to understand why they are taking such a long time to do the wide range swings in the market before making any big upward or the downward move. And also another important factor, namely the US elections. Normally during that of the US election time, the players used to book profit and stay in the money, and they will sit in on cash, and they don't invest much because they want to find out who is going to be elected and negotiate and find that they are not caught vulnerably for the insider trading, and then subsequently they go in for the big moves in the market. So ultimately we need to understand it is a man-made market, and it is a perfect understanding of the manipulators. With that of the government, they are able to make big moves in the market, and they may give various other attributes. They may say that it is because of the economic conditions, it is because of the data, etc. All such things are all nothing but the attributes. But ultimately, why the players make investment in the market is to make big money out of making huge investments, because such trillions and trillions of dollars, no bank will be in a position to accept and take as fixed deposit and give an assured interest return. So the only possibility is they can take it in the private arm of the bank and deploy it in various markets, and then enter and exit from various market. Thereby they are able to make huge profit for such investments, and also they are able to float the market. In the process, what happens? The banks also earn huge money. And if you think that doing the transactions for us the bank is earning money, it is not so. Suppose you make a deposit and withdraw money, the bank is only extending a service, and they are not really making a big profit out of that. Probably they can put the money in the call market, etc., but that will give only a meager profit. So what is more profitable for them is market manipulations. So in all the markets you come across, the banks going for such manipulations with the help of the operators, and thereby they are able to make surprise moves and create uncertainty and trap the traders. So we need to understand how exactly the players are going to make the moves. The forecast says that. Now today they are expected to make the swing and rise moves in the case of Euro and GBP, and tomorrow also they are expected to make either way moves, rise during the Japanese session and slide during European and rise during US session. And then you find that Wednesday FIMC minutes, FIMC decisions are to be taken, interest rate decision and the statements, and people might say hawkish, dovish, all sorts of things, and ultimately what the players are expected to make the move, swing and slide before that of the by start of the day, and firm up a little bit during the European session and drop before and after that of the FIMC. Then in such a situation, people might think that market is going to be very bearish. After gaining the levels for 2 days, they are expected to drop on Wednesday. Then immediately people might think that market, we have to do sell and buy trade. But the players make a dip during that of the 20th Thursday and gain the level and drop during that of the BOE interest rate decision again, and then start gaining the level during US session as a surprise trap. Then they are expected to make the swing and slide on Friday to induce the long holders to liquidate the long position and start rising during that of the European and US session. So whether you take a buy position or you take a sell position and wait for some time, the players will show the loss for us. So we have to quickly grab the profit when profit is seen. There comes our skill set. Then next week, it's the 4th week of the month of October. They are expected to make the monthly trend reversal, trending move on the upside, but they will not make a straight upward move. This being the last quarter, they will make volatile move, but the upward might be there for a day or two and then reverse quickly, then again make upward move. That sort of moves they are expected to make during this particular month. After the US elections, once the results are out, you'll be able to see a surprise upward move in the case of Euro and GBP. And you might think that after the US election, the envisaged person has become the president of the United States. Then US dollar is expected to be very strong. But the players use the US dollar to buy all other currencies and rig them and gain very big. And simply they will say it is risk appetite. So this is how they are going to give the interpretations to that of the various moves they are going to do in the market. Now coming to that of the levels in which the currencies are expected to make the swing, and Wednesday you look for a big drop in the case of Euro and GBP before that of the FOMC and after that of the FOMC. Then afterwards they will reverse towards the close, and that will be a great buy opportunity. And you know that no currency they will bring it to zero or to that of the higher infinity. They will make upward and the downward move alternatively. It will appear that they are making a downward shift, but subsequently they will make the upward shift as well. And when they are making a downward shift in the case of Euro and GBP, you also come across that they are making downward shift in the case of USD yen in order to make big drop in the case of yen crosses. Similarly, in the case of the commodity pairs, they make contrarian moves, and they also make USD gaining and the USD weakening move alternatively, respective of the USD gaining and the USD weakening move. They do it in the case of Euro and GBP in order to handle Euro Canadian dollar cross or GBP Australian dollar cross, etc. So ultimately, you need to understand with the help of the net change what sort of moves they are doing it in the market. Now you find the contrarian move. Euro is showing the positive net change, whereas GBP is showing the negative net change, which is a contrarian move. Euro is showing USD weakening move. GBP is showing USD gaining. So if we take a buy in the case of GBP, you find that Euro might be gaining, but GBP might be holding because they are handling Euro GBP cross on the upside. They are gaining the levels in the case of Euro GBP. Because of that, they hold the GBP and gain level in the case of Euro. Then similarly, in the case of USD yen, they are showing negative net change. GBP is also showing negative net change. So you find that GBP yen will be showing negative net change. You can see the cross. GBP yen will be in negative net change. So ultimately, they handle the majors and then come to the other crosses. Then you find that GBP is in negative net change and USD CHF is in negative net change. Because of that, GBP CHF will be also showing negative net change. Yeah. So this is how they push, make the contrarian move and make upward and the downward move. Such contrarian moves is part of the game, so that people might be thinking that crosses are unaffected because of the US dollar sentiment or because of the uh, data release, etc. But actually, the players make big moves in the case of the majors, and that in fact gets reflected in the case of crosses. Then, in the case of commodity pairs, you find that they are showing the USD gaining more. Australian dollar is showing negative net change, and Canadian dollar is showing positive net change. So, the commodity pairs are showing USD gaining more, but Euro is showing USD weakening more. USD yen is showing USD weakening more. So, whereas GBP and the USD CHF are showing USD gaining more. This sort of upward and the downward move they make in the market. That we need to understand. So only then we'll be able to really take appropriate trading position. When they are handling crosses, if we try to take the position in majors, we may not be able to see good profit. Always see that they make 40 pips and more spread between the high and the low. Then commit position in such currency, identifying what sort of moves they are doing it. Then you will have a decision profit. And on Wednesday, I'll be giving the Tracking the Forex Market Together webinar. During that time, I'll take the live position and explain to you how our trading decisions are expected to be. So Euro and GBP, they could make further one big push on the downside on Wednesday and start gaining. At that time, you could come across, before that they could make a drop in the case of USD hold it near that of the low. After that of the FOMC, they are expected to gain back again to 104. So that sort of move they are expected to make, drop USD yen first, then followed by that Euro and GBP drop and USD yen bounce up. Then later on, from Thursday, Friday, Euro and GBP also bounce up. CHF will be making a narrow range swing, and also in the case of Canadian dollar and Australian dollar, they are expected to make the USD weakening more slowly. Now let us see the market reading. We note down the initial lows and the highs around 3:30 GMT and find out where exactly the market is heading. Now in the case of Euro, 1.0964 is the low, 1.0983 is the high. They breached the high and staying above that of the high, indicating they went up to 1.0990, indicating that they wanted to hold above that of the high, initial high, and slowly gain the level. And they should cut the new high every 30 minutes to indicate that it will be an intentional move on the upside. Watch carefully. In the case of GBP, 1.2152 is the low, 1.2182 is the high. They are not breached the low or the high. They are simply holding it in order to handle Euro GBP cross. They want to gain levels in the case of Euro GBP cross, but that they are holding GBP near that of the low and gaining the levels in the case of Euro. Then in the case of USD yen, 103.94 is the initial low, 104.38 is the initial high. They are not breached the low or the high, and it is holding around 104 level. Slowly they will hold, and net change is negative, and they are expected to make the slide. Then in the case of CHF, 96.90 is the low, 98.90 is the low, 99.08 is the high. They are not breached the low or the high, simply holding it. And in the case of Canadian dollar, 31.30 is the low and 31.73 is the high. They are not breached the low or the high. Then Australian dollar, 75.81 is the low, 76.21 is the high. They are not breached the low or the high. So in all currencies excepting Euro, all currencies, they are not breached the low or the high, indicating they are simply holding the market and making subdued moves in order to attract the traders to take positions. Then later on, they are expected to make the whipsaw moves. So the recommended trades for today, they are expected to make the swing and gain, then again drop and make the swing and cut the low before making a rise. So you can just wait for the drop and take a buy, or you can just wait for the end of the Japanese session and take a sell. And during the European session, when they drop initially, you can book profit. About 30-40 pip swing will be seen on either side. So you can do the swing trade. And they are not expected to make any big upward or the downward move. So whenever they make a quick upward stop and above that of the high, you take a sell. Whenever they make a downward stop and below that of the initial, you take a buy. That way, you can do either way trades in the market. So dips are buy opportunities. Now these are all the market timings. So the session timings are given here. So from next week end onwards, the daylight saving system will be off in Europe. Then from 31st of October onwards, you will find that European session will start by 8 GMT. So you will find that there is a shift in this one, the Japanese to European session. Japanese session will get prolonged up to 7:30 GMT. 7:30 to 8 will be the gap time. Then 8 to 13 GMT will be the European session. And US session will still follow the daylight saving till the following week. Then from 7th of November, you'll find US will also switch off the daylight saving system. As a result, the US session will start by 14:30 GMT and end by 21:30 GMT. I will show the appropriate slides at that time indicating the exact timings for those weeks. Now, if there are any questions, you can ask me in the question answer window. I'll be willing to answer those questions. And I'll come back on Friday, 21st of October, and do the review of the forecast, what I have given it today, and also explain to you how exactly the market is expected to behave on that day, so that we'll be able to objectively review and understand whether the forecast is dependable. Then on Wednesday, I'll be doing the tracking the Forex market together webinar part 1 and part 2. Part 1 from 8 GMT to 10:50 GMT and part 2 from 14 to 15 GMT. During that time, I will give the trade call and take the positions and show you the results during part 2 of the webinar. So we'll be able to understand really how, following the type of market moves, you have to take the positions. Then on Thursday, 20th of this October, I'll give the spike trade call before the ECB interest rate decision. So by 11 GMT, I'll give the live trade calls. On 13 GMT, I will just review the results. This spike trade call is mainly given for a small traders to get rid of the market fear and try to understand how the players are making spikes in the market. So once you understand how they are making spikes, then it is easy for you to enter and exit out of the market. If the spike becomes a surprise, then you avoid and you invariably say, let the market settle, then later on I'll enter into the market. But that time has not come, because the market moves are similar to that of the waves in the sea. So when the surfing sea is continuously making waves, you cannot take a decision, let the waves settle, then I'll go for a bath, then the waves may not settle. So we have to understand market means volatile moves, and we have to view the volatile moves as the great trading opportunities rather than simply take a move when the market is subdued and waiting for 2-3 pips profit and say that I'm doing good scalping. So that is, we are cheating ourselves because we are not able to understand the intentions of our players. So aim for a few pips or 5 pips, 10 pips trades and say that I'm doing scalping. These are all nothing but trying to get convinced by themselves. But ultimately, what for we are coming to the market is to make substantial money for living, but we should not forget that objective. So if there is no question, then I'll just show the forecast for this week. So this is the forecast for the week. The expected range in which the currencies are expected to swing this week. And also the market reading, the initial lows and the highs to find out where exactly they are taking up the market. So no question is coming up. Okay. Let me take this opportunity to thank FX Trade for the facilities provided to present the webinar and you people for your kind presence. I'll come back on Wednesday and give you the next webinar, the tracking the Forex market together, and also on Thursday for ECB press conference, the spike trade calls, and on Friday the review of the forecast what I have given it today. Wish you all happy trading. Try to learn the art of trading and also do fearless trade. Wish you all the best. Thank you.